Hi, this is Randy Finney with the right side of the chart, and today is Monday, April 25th, 2022. It's 2:11 p.m. Eastern Time as I'm starting the video, and I wanted to do an update on the main asset classes I'm highlighting. I've been trading for swing and trend positions now, which are the equity markets, short equities, and then long treasury bonds, long gold and silver. I'm going to highlight that. Gold pulled back buy point, good support level today, so I'll do an update. Even though I got one out to you this morning, we'll just hit on those charts. But let me start out here with the equity markets. This is obviously a lot of volatility lately, a lot of profits to be made, swing trading the equity markets. Gosh, I don't know where to begin. You know, if you're new to the site or coming in for a while here, this is where really it's a continuation of this started shorting the NQ, the Nasdaq 100 with downside targets on the daily chart here, a 60-minute, I'm sorry. And then as this trade got going, as I said, I would likely do extended targets, which were still in play. The targets on the weekly chart, which have already been hit. We'll revisit that in a second. But we had multiple sell signals, one here, second one there on those two trend line breaks, and then every bounce back. We had a line up there at the time that was a big 405 resistance level, offered multiple shorting ops. Even as a swing trader, even not a very active one, there have been plenty of opportunities, and there were, to game the rips and dips. So it's been a very profitable year so far for trading the indexes with the volatility. And that's the thing about market tops and corrections or bear markets is volatility expands. That's why the VIX is going up. It's a measure of volatility, and you get these big moves. So this is where we're at. And then most recently, this is where I highlighted re-entering after pivoting here, talking about that divergent low and covering shorts when we had that double bottom there, and then getting back in from here to here, scaling back in, right? I forget exactly where it was. That was all covered there. And that was it. And that was a key level right there, that big 370, big resistance, and pointed out as one of the last and best objective shorting ops we've seen in a long time. Hands down, we were at the 200-day moving averages on the S&P 500, backtesting for below the Nasdaq 100, key Fibonacci retracement levels, price resistance. It doesn't get any bigger than that. Those are the three main type of resistance levels I'll look at: price resistance, as well as including trendline resistance, moving average resistance, and Fibonacci retracement levels in a downtrend. And so far, so good. We reversed pretty hard there. And even then, along the way, and I'll continue to do this to the best of my abilities, point out objective levels for those not in shorts yet, or those that are long wanting to get out. And so we were highlighting, or I was highlighting this range here. We were bouncing between there, instead of favored a downside break, and we had another objective shorting up right there recently at that 347.50-ish level. And then this happened. And that's what I was calling for, predicting would probably happen after we saw what happened to Netflix. And remember, Netflix, a big drop in the stocks, down I think 70% or something off the high. Facebook down over 50. I use those two examples, those two big, very popular, widely held stocks, market leaders, at least very much Facebook. And said we'll probably see that some profit taking from nervous longs in the rest of the lot, and the lot being the Fang stocks: Facebook, Amazon, Apple, Microsoft, Google, even Tesla's up in that level now. That's what's happened, or that's what happened Friday. So then to kind of recap today, I said, look, okay, we got that. We got a lot of it. That was the biggest drop, and I think since I saw a headline, I think it was like since 2011 in the Dow. I didn't mean it was like 2011. It was 2020, I believe it was. We're staying a couple years for the Dow, and again, that is because we did see that. Now there's finally that nervousness that, hey, market leaders are getting taken out to the woodshed right now. So I mean, honestly, wouldn't you do that if you were a fund manager, hedge fund manager, even an individual investor, and you had these such big embedded gains in things like Apple and Microsoft, Amazon, Tesla, and of course the technicals are in play here too. So whether Whether that was the correct or a large part of the reason for the big sell-off on Friday or not, it's hard to argue the technical stocks like Alphabet breaking support, key support level, all these things I've gone over recently. So we're not going to get into the nitty-gritty, but the charts remain the same. I've covered these fangs. I cover them fairly frequently, as often as last week. Let's talk about the near term today. So I suspected we'd probably see just kind of choppy action with a, potential for a tradable bounce, and so far that's what we had. There's the Nasdaq 100 60-minute chart. I had this trend line on here. I've moved it off so I could show you something, and I suspected we might get a little pop, which we did. There was that low when the post came out today. So there's been a nice lift in the Nasdaq from where we were in the pre-market. Earlier today, it's been about a 2% bounce so far. Why did we bounce? Well, number one, one of the likely catalysts for the bounce was that level here on the 60-minute chart. I'm just toggling back and forth between QQQ and Nasdaq 100. So on that one, I got out to you this morning, and just to recap it, the big level here is this 2172 level on the RSI. If you go to any charting platform and you turn on that indicator, they're going to usually, the charting platforms will give you two levels as a default. One is 70 for overbought, and the other is 30, the blue line here, for oversold. But guess what? That doesn't really do the trick for Nasdaq 100 or QQQ or a lot of other securities. So I put my own lines. I just study the chart and I see, okay, where are the extreme spikes? And so to the upside, it's about 79.74. We'll call that $80. That's about as high as the RSI gets. Not that it can't get any higher, but usually when it hits that level, it doesn't stay there very long, and then you usually get a top, especially in a downtrend. Sometimes you'll get a second lower tap. I call that, a double tap with a lower low. That is negative divergence, and that's what we had right there. That's the divergence line on that bearish rising wedge I gave you last week there. And there was the breakdown, or the week before, a couple weeks ago actually. Breakdown, boom, 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 boom. All right, so now, okay, let's forget about that. This is what was highlighted this morning. There it is, 2172 is that orange line. We hit it there, 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 there. We had three consecutive quick taps in quick succession right there, there, and there. So what happened? Well, we'll see what happens now, but we've already had at least a small tradable bounce of about 2%. You had one there that was took you all the way up there. You had one there, and that was probably, I'm just eyeballing it, 4-5% maybe at least. There, much more than that. That might be close to 8-9. Another one there. All right, so you get the point. That's there, right there was the. And again, they're not huge moves, but that's almost 6%. It's just something to keep in mind if you were wanting to short today. And I wanted to go over that and make the point to get the post out to you, because I said earlier that I thought as we get down close to this level, we'll go on through, and I still do. I still believe 318 will get taken out. What happened, I've been talking about that for weeks and months now, even saying that once we get down there, we'll probably do that. But, so we say the charts are dynamic, and so is my analysis. So what has changed? Well, we have all the remaining four big market-leading Fang stocks on deck to report this week. Both Microsoft and Alphabet are going to kick it off tomorrow after the close. Tuesday after the bell, they'll report. Wednesday, you have Facebook. You also have PayPal, Qualcomm, Ford, some other big names to report. Thursday, you have Amazon, Apple, and Intel. So my experience is there's usually, quite often, there's been some pretty big pivots come this week. Those big fangs, it's not coincidence. They always report four of them on one week, and then one is usually off the following week or before the week before. So you always have that cluster of the biggest stocks, the biggest companies in the world, the market leaders. These are the highest growth companies. They're not the biggest companies just because they, for whatever random reason. It's because they have hyper growth rates. Apple, Microsoft, Amazon, they're huge earnings juggernauts. Tech companies are inherently thin, lightweight. They don't have the chassis and the baggage like old, market leaders of yesteryear, the car makers and, AT&T telephone companies. Their tech companies are just more streamlined because they're selling digital products and services. They don't have, for the amount of revenue they bring in, they don't have as much payroll, and that's a huge, downside for companies dealing with all kinds of labor costs and unions and all that good stuff. But we'll see. Amazon, they're knocking on an Amazon store, aren't they, with that? All right. Anywho, so the point is, you have those fangs coming to report, and the market will often go into a holding pattern. Now, with that being said, I still think we'll drift lower by the end of the week. We'll probably flirt with this 318, maybe undercut it, maybe take it out. I just don't see, outright crash and a big drop likely until at least the majority of the fangs are out of the way. A couple of them report, like I said, Microsoft and Alphabet are both Tuesday after the close. Then that only leaves really PayPal, Facebook. If Facebook's already been whacked so bad, the downside there is probably much more limited. The ones that I'm eyeing are the ones that really haven't given up the ghost yet, like Apple. It's not too far off its all-time highs. Microsoft, Amazon, they've then speed up a little bit more, but they still have plenty of room to go for my longer downside targets. So, all right, a lot of rambling. I just wanted to kind of put my share my thoughts again, that don't be frustrated, don't expect this again today. That happened, we got it, we had it on Friday, and I don't think we're going to see that much more of it. We could see things go the other way. We can come up here and back test. We took out those trend lines. That was a sell signal pending this morning, and then boom, we got it. And so there's really not much resistance up until a back test of that 35.22. Remember last week I had color coded the most important levels and highlighted this trading range. Said that would be bullish, break above 347.50, and a break below here would be bearish. And I said that was what I favored. And that's what we got, and it was a big drop. So that's it. Now we can look at it this way. Now you want to get scary, because I don't want to sit here and say, oh, we're not going to drop or can't drop too much. If you're eyeing this, I just showed you that flag that occurred on the NQs, and it was right here when we hit that support, but you don't see it on QQQ because QQQ doesn't trade, around the clock and overnight like NQ. So what you have here, and this is still a very important index, it's the Nasdaq 100. It's just a tracking ETF for it. So that you had a straight leg down, and now you have what could be bear flagging. It appears to be. You want to see a bear flag. It's a slow a drift up after an impulsive move down, a nearly what I call unidirectional, almost a straight drop, with an angle like that, of course, but no zigging and zagging along the way. That just doesn't fit. You get that impulsive drop followed by a period of consolidation with slightly rising prices on declining volume. You can see down below. Here's what's going on in the volume. I'm just drawing the top of the bars. And so that does fit that. So I'm going to throw it out there. And again, nothing's changed. I made it very clear this morning. If you're an active trader, you want to game this bounce, great. You already made at least 1%, depending where you took it, maybe 2 if you got it towards the lows today. But swing and trend traders is longer term swing traders or trend traders with their eye on the prize, and that would be these longer downside targets on the weekly chart. T2 still being all the way down here around 295 to 300 next target, and then if that gets hit, it's going to increase the odds that we'll, even if we get a reaction there, which is likely, that we'll work our way down ultimately. Because when we get down there, we're going to be pretty much in official bear market territory. At least the media will be flashing that headline. So far, we had better than a 20% drop in the Nasdaq 100, but not the S&P 500. So you didn't really in the Dow. So you need that, those two to officially take out and cross and close down below the 20% below off their highs. Then the media starts plastering the headlines, and then the nervous Nellies start selling, taking money out of their 401ks, and that's usually where you get that next impulsive leg down. The Elliott waivers call it P3, primary one on a 5-wave cycle. Primary wave 1, wave 2 up, 3 down. 3 is always the most powerful wave, and that's why we could, with very little to no reaction, cut through T2 and head on down here, and then do something like that. Come and back test that 300-ish level right there on a P4, and then get your final wave down to hit my final targets. That would be a perfect view. It doesn't have to play out that way, but Elliott wave has its group of followers, and there's pros and cons to it. I just find it a little too subjective after the fact. After the fact revisions on the wave counts, to make it that useful for me. But I've seen a lot of the counts that do play out. Corrections are usually in ABC, corrective waves, those kind of things. So Anywho, important thing is these are the recent lows, and what else do I like for the short case? Forget about short term. I already told you that. We just trail it up. If you're trading, I'll give you some intermediate target. Well, let me give them to you now, in case you're actively trading this bounce. Here's a gap right here. Gap is at that level. We're struggling or about to test the bottom of the gap. Oh, we already tested it this morning. That was almost a perfect test of the bottom of that gap. See, traders will flock to these levels. I told you there was really no big price resistance on QQQ up until we get back up there. And I'm going to actually raise this number a little bit right now and tell you that's closer to about 335.83. I had to just tweak that line a little. But again, you have a gap coming into play right here. And try my box tool. It's easier to measure the gap. There it is. The gap looks something like this. So that's about what we hit today. We had a quick pop up to the bottom of the gap. So if we can get into it, then the odds are we'll backfill the gap. And the top of that level comes in about roughly 332. All right, so there's a potential target there for you. Let me give you the NQ chart, and you can see right here. I'm going to zoom in a little tighter. Take it in tighter, 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 tighter. Remember, there was our flag, 60-minute flag, flagpole, breakdown, pretty much hit the measured target. There's not a whole lot here, but I can tell you I have on a 5-minute chart, I have resistance, a target level right about here, about 13,502. Let me drop that down to that 5-minute chart for you again. This is for you active traders, swing trend traders. I wouldn't be overly concerned with this now. Everything I'm seeing, I'm getting a lot more check marks that I've been looking for in the bearish case. We still have to take out those recent lows. Remember, we didn't do it yet. Go and run at them, maybe make a triple bottom test, but I do think they'll get taken out. So that was a level. Here was the 5-minute chart. We had this positive, aka bullish divergence this morning. This was right shortly after, right about here. I got the post out to you this morning in pre-market, and then the divergence on the 5-minute chart playing out. So this, coupled with the fact those bear flag continuation patterns played out to their measured target, and we already had a big drop. We were very oversold. That's why I thought we might reverse a little shy of the those recent lows, and so far that's been the case. So levels right here, 13,507 right there, and then this is probably the biggest one right there. There's a little minor level. I have it at 13,583.75, and then 13,653.50-ish. Okay, so those are your targets. This is the one I'm preferring. That's my sweet spot for this morning, where I reverse as an active trader. I've got some reverse orders in there, sell limits. So what that does, it takes, through my broker, you can action one order. If you're long, 5 contracts NQ, and you want to go short 5, when you hit your target, close those, you just put a sell limit order, sell 10 NQs, and boom, it'll do it in one fell swoop. It'll take the 5 you had, close those out long, and it's going to sell 10 for you, and then put you 5 short immediately. That's what I refer to as reversing a trade. Going from short to long or long to short on a level. I expect a reversal there. But at this point, it's prudent to trail some stops up, because I'm going to just, and I know I'm spending a lot of time on the indexes, but this is where, A, we make our money as traders when volatility is high, and B, when you're shorting, and I've always said this, I love shorting because the profits are they come faster in quicker order than being long. Markets tend to fall a lot faster than they rise. Look at any correction or bear market in history, compare it to the previous move, usually in just a matter of weeks, months, and sometimes even years of gains are wiped out during a correction or a bear market. And however, the thing is, you got to know what you're doing. You cannot stay too late to the party. Because of that, even during a bear market, when you're still within the trend, the bear market rallies are powerful. There's a combination of short covering. You get higher short interest in a stock that's in its own bear trend, or the stock market when it's in a bear market. And so when you hit support levels, buyers step in. They always are looking for the bottom, so they're going to buy, and then the short sellers cover, and you can have a very swift reversal. So I always say don't stay too late to the party when you're shorting, or you're going to watch some very nice gains evaporate quickly. All right, but big picture, nothing's changed from a longer term perspective. Trend traders, swing traders, don't try to, if you're not an experienced and active trader, sitting in front of a computer all the time, watching a lot of indicators, a lot of charts, and don't have the experience, don't try to game the little squiggles. What I saw, or what I'm seeing now, I'm just going to bring this home here and then move on to those other asset classes. Remember, I told you before we had some positive divergence right here up to this point. That line's gone, but I'm going to put it back there. Had a line there. We had positive AK bullish divergence there, and I said that should normally be the catalyst for the next big move up. Last time we had divergence was there. This is what I wanted to see, exactly this. Just as it started to play out, they sold into it. They tried again, they sold into it, they kept selling in, and then boom, it is now gone. That divergence failed to play out, and that is more indicative of a bear market, a bear trend, a larger bear trend. Now, again, nothing goes down forever. The markets are like a rubber band. You can stretch it. The more you stretch it, it's eventually going to snap back. Sometimes it'll break. Those are market crashes, and I'll look for that. Again, I just don't think the market's going to crash with four of the largest companies in the world scheduled to report this week. And not only for the largest, these are earnings juggernaut. They're going to blow it out of the water, blow it out of the park. They always do. They always come out with record earnings, blah, blah, blah. And again, it's not about how good a quarter they report, or even their forward guidance. Sometimes any of those can rattle the markets. Don't get me wrong. Earnings miss or disappointing guidance can certainly be the catalyst for a drop. I'm not saying that's not going to happen or can't happen. But the most important thing is not how they report, but how the market reacts. And what's quite bearish is when they come out with a rosy quarter, rosy forecast, and yet the stock still drops. And I'm not talking at the after hours trading session. That's noise to me. It's how the stock will trade in the coming days to weeks after earnings. And again, I've seen lots of major tops and bottoms come on. I've seen tops come on very rosy quarters for companies like Apple, and I've seen some bottoms come on just ugly, abysmal quarters, but it was because the stock was washed out. It had already been in a correction or a bear market, and then you get that point of seller exhaustion at the bottom, just like you get a point of buyer exhaustion at the top. And what does that mean? It just means when everybody and the brother has bought their last share of Apple, every bull out there, and I'm not literally speaking, metaphorically speaking, when everybody owns Apple, and they all have their fill of the stock in their portfolio, including, especially most importantly, hedge funds, pension plans. Who's left to buy at that point? If everyone's that's a bull on this sector, or it's a fund that can hold this stock, it meets their criteria, well, they're probably chock full of it. And that's why you get bear markets even in great companies. I just want to say that because I know this one and some of these others have very loyal fan bases. So we'll see. And then technically, Apple's like all the others. This one hasn't taken out the 200-day moving averages yet. But when it does, and once Apple solidly breaks those, it's usually in bear markets. You can see that, and you can just turn off all these lines and just see. I'll show you real quick. We took out the 200s back here in fourth quarter 2018. That was a whipsaw, got right back above it, and that also came right after a big drop. There was COVID. We were below it. Other than that, it's a bull trend. Oh, and then you took it out back here, and you stayed. This was over a year here where you stayed below it, and it was resistance, the 200 days. On the weekly chart here, their show is 40 weeks, same as a 200-day moving average. And those drops were 34%. So there was over a year-long bear market in Apple, with resulted in the stock losing about a third of its value. Lost about 40% there in the fourth quarter of 2018, 35% there, and that's that. All right, let me move on to let's do Treasury bonds. All right, so all right, to be very clear, said I'd move on, but I think these recent lows will get taken out. That could be a bear flag, and give you some potential upside targets. But to be honest, that may be all we get, and that's I'm not looking for a big bounce here. Even though we hit that little level there on the RSI, sometimes you only get a little tradable bounce, and remember we're in a downtrend. So so far so good. Need to take out these lows. If it happens this week, great. Maybe there is a big drop. And if so, the catalyst will probably come, my guess would be Wednesday, because then you have the first two that will be out of the way, Microsoft and Google. If market doesn't like what they're selling, that could certainly be the catalyst for start. And for those of you that are bullish, hey, if these recent lows get held or even get slightly undercut but then recovered, you have divergence at that time, and a lot of stuff happens, go long, buy it, buy a breakdown and a recovery if you want, and just set your stops. Maybe I'm wrong and we'll never see my weekly targets, at least not for a long time on the downside. I don't think that's going to happen, but I can tell you this is a big level. So if QQQ can hold it or undercut it and then recover it, be a bear trap, well, there's your trade, if that's where you think the market's going. Okay, on to Treasury bonds. As I said, that's I do like Treasuries. I think the risk reward is very favorable. It's a hated trade right now with the Fed exiting their bond holdings, and that obviously has put pressure on. But we've had one of the largest drops where I've showed you before. I'm not going to spend a lot of time here. Revisit the recent posts on that. If you're new to the site, just look below this post on the website. Go down to the bottom. It'll say tagged, and it'll have symbol tags. It'll ZF. There'll be a /ZF for this is the 5-year Treasury bond futures. I usually include IEI for that because that's the ETF that tracks the 5-year. And then you have ZN. That's the 10-year Treasury bond futures, and then that's comparable ITF. I'm sorry, ETF, IEF. There we go, a little tongue twister. And then finally ZB, the 30-year bond futures, and TLT is the ETF that tracks that. So when you click on those tags, it will bring you to all previous posts that covered with analysis on these, any of these that are tagged in chronological order, so you can catch up that way. But near term, remember, long term, we've had yields running into or very close to major downtrend lines. So I am still very much longer term bearish on bonds. I am just short term bullish, and again, I think the risk reward has been favorable. We already hit the first two targets here in ZF. That's where I've been overweighted in the shorter end of the yield curve. We hit T1, T2, had a reaction there, continued the divergence, and then recently took out this wedge right here. See, the divergence was in place at that point, still built, and then boom, boom, we hit. I retasked these targets, if you will, last week. Gave you levels here, 112, 280, and then 113, 107. Boom, we hit that to the button today. And then stocks started rallying, so that stopped that, as to be expected. So I am still bullish. Still think we'll continue on up here whenever this near-term bounce that we're having right now in the market runs its course, whether there's a little more downside or not. I am not, I'll tell you this, normally I game the little squiggles, micro squiggles. I don't want to let go of my bond positions now. And it's also a way to hedge, by going long this morning, reversing, as an active trader, NQs and the RTY, the small cap futures. But sticking with these, if I'm wrong there and the stocks went down, this would probably keep going up because you're seeing a flight to safety bid right now. And the other thing is, Twitter's halted. Showed me that. I took some Twitter a couple days ago figuring that I could see no downside based on what's going on. So maybe that's not good news. We'll see. I'll check on that. I'll show you the stock chart in a second since it gave me that pop-up. But there's the uptrend line right there. And again, so you get two things going. You get a flight to safety bid. Bonds, Treasury bonds have always been the go-to flight to safety vehicle for institutions. Gold's kind of a hit or miss thing. It is often a flight to safety instrument, but the gold standard, no pun intended, it's not gold, it's actually Treasury bonds. That's where institutions flock to in times of market turmoil. So that should put a bid underneath the Treasury bonds. And then the other thing is, remember, the Fed is backed into a hole. They tried and tried and tried to deny inflation was a real issue, calling it transitory, till they couldn't do that anymore. They ate a lot of crow, pulled a 180. So now we know, and they've made it clear, they've already started hiking. They're going to continue hiking, but they don't want to. They know this economy is super addicted to the juice, to low interest rates, and they know there are going to be some serious repercussions, fund blow-ups. There's a lot of leverage out there, things like that. And with Russia, that only magnifies the risk. So where I'm going with this is, they will probably welcome a market correction, because if we get a stock market correction, we've already seen interest rates surge, housing market's cooling off. I get all these follow homes on Zillow, and I'm getting a ton of price drops recently, a huge surge. Months ago down here in Southwest Florida, our market's been on fire. There was no such thing as price drops for a while here. Everything, all houses were going above ask, and now I'm seeing more and more price drops. Anyway, so that's cooling down. If the stock market cools down too, that's going to take away the wealth effect, and that's going to do a good deal of the work for the Fed, and they know that. So where I'm going is, yeah, you can see that if the stock market drops, that would also help to alleviate future uh, growth expectations in the market, which would then in turn go to help alleviate or reduce some of the pressures on inflation, at least so in theory. And so therefore, that's why I think a falling correction in the stock market from right to where we're going is going to help Treasury bonds, because then all of a sudden you're going to hear the little buzz, oh, maybe the Fed doesn't have to be as aggressive as they wanted to, because the market's doing the work for them now. All right, hopefully that makes sense. And I'm giving you, as I like to do, technicals first and foremost for me, but fundamentals as well. So there's the 5-year, the 10-year. Also, same story. The divergence was there. We hit our first target recently, had one more marginal new low. The divergence is still very much intact. And then recently we broke out of this downtrend line, moving up. And so T1, the former target, which was already hit once, still the next target, 121.066. And I still have these additional targets there for ZN. And that's, again, IEF if you trade that ETFs instead. And if you do ETFs, remember, these are Treasury bonds. They don't move much. They don't drop 5-6% in the day like a stock market can on an extreme. But they don't go up as much either. As such, I call it beta adjusted position size. You could use a larger position. The future is already leveraged for you. But again, even then you can take more than you would 2-3 times as much as you would trading the NQ, the Nasdaq 100, or the small caps. Last but not least, market related is the VIX. That's doing well. The VIX had that positive divergence. Volatility is still up. We had that. Here's an example of a flag that played out and then some. You had a move up, bull flag, and then pop. We've been consolidating. These are all levels laid out in advance, and you can see how well they're playing out. If you've been trading this one, these are VIX futures, the May contract.
Someone's at the doorbell cam.
Oh, 1 second. Okay, I'm back. I had somebody at the door. All right, there was the 2642 again. Looking at the near term, that upside in the market, we've taken that out. So you could see there's would be an objective re-entry if you took any profits here or here, which would have been prudent if you thought the market was going to bounce. For that logic, you're going to see a pullback in the VIX, and that would be a level to re-enter that. Or if you don't even have a position, you missed the breakout because it happened so fast, right there. And then I gave you guys, for you non-futures traders, what was it, VIXY, as well as it has a 2-time leverage counterpart as well, the same company, but this is the one without leverage. You really don't need to use leverage in trading the VIX. The futures, of course, are leveraged, but even these ETNs will move fast enough. But there it is. You had that move up, pullback, that would be comparable to the level I just gave you on the VIX futures. That's 1747. That was our breakout right there. Was resistance here, here, here. It's good support along the way, and that's what I favor. And this would be my guess if things go the way I think they will by the end of this week, going into next week. All I can say, I can't guarantee what's going to happen after these big Fangs report this week, but I can tell you if that is just as likely as any catalyst I can think of, including but not limited to the Fed, to cause a break of the recent lows in the market and start the next leg down. So we'll see. Maybe it proves to be, maybe not. Unless the technicals change, that's still the way I'm leaning longer term. Okay, we'll wrap it up here with gold. Let's do that. I got a chart out for you today. I put it as a hard buy back here. I'm not as crazy about it, but it's certainly objective, hands down. I'm not trying to waffle. The only difference now, back then we had nice positive divergence. And it did play out. It played out for the biggest bounce since back here, since earlier this year. And that bounce was in gold futures. I have to draw a line like this, measure it, and then go down, pull it up here, and tell you it was about a 5, almost 6% bounce. So not bad, but we're back to where we started. So again, this was that hard buy there. Came up, then we went in this trading range here, right there, right top of that, and the bottom. Then we broke it there, but what happened is we went on to put a divergent high right there, and that divergence played out for a bigger drop than I expected. But again, we're back to where we started. And if it was support back then, and we had a very distinct and clear reaction right off it, it's even better support now. And that's how it works. The more reactions you have on a level, if we bounce here and we come back to it, it's going to be even better defined if we have another reaction. If we go through here now, well, guess what? Support, once broken, becomes resistance. So listen, I am very open to the fact to see a whipsaw. This market, in fact, it's been littered with whipsaws in recent years. I think the algos, the computerized trading program, those algos that are written, they know where the stop should be, and they do it all the time. So what I'm getting at, I wouldn't run a tight stop in gold. I'd give it a little bit of room. And if you don't own a position, you don't like the action recently, believe me, I'm not crazy about it. The fact that we've come back in there, and that's why it's not as hard to buy. Plus, where I was going before, we don't have the divergence anymore. That's what we had back here. However, support is support. So I'll buy that all day long. And if we drop below it, what I would do if you don't have a position you're looking to add is not buy the breakdown. Absolutely no. Wait for the recovery back above. Then you'll have a bear trap, aka false breakdown, and you can buy the recovery back above that level. And then there's also a potential downtrend line here that might come into play. So this is, something along these lines. Whether we get divergence or not, look for a break above the trend line, and then the same levels all the way up. And of course, if we ultimately take that out, that's going to be quite bullish. But as of now, gold's been stair-stepping higher. So my long-term view on that hasn't changed. I'm going to go here, and this is the big picture. We go to the weekly chart, and we had this big symmetrical triangle here on the weekly chart that was we triggered a major buy signal. I was watching that, highlighting that for a long time. The triangle pattern plus that 174-ish resistance, we broke both right there, ran up, tested the previous highs, and as expected, it was an initial test of that in years. That, by the way, is also the bear market high, or just above it from back, the bull market back in 2011, gold peaked. We overshot that by a hair. And so that's it. We had a breakout and a little consolidation. And so far from this weekly chart, gold looks good. Gold can even come down here to 173.87 and still look good in my book. Where doesn't it look good anymore? Well, if it fails the triangle, comes down, tests, and takes out especially the lower trend line. At this point, it would have to come in. You see, if I extend the triangle lines, you get the apex of the triangle. So we could come in there and test either of those lines. I don't want to see that. I want to see a reversal here. I don't like that bearish engulfing candle right there. It didn't come at the very high. Bearish engulfing candles like this are also often reversal sticks. You need the body, the fat part, a red candle to engulf the body of the previous green candle or candle, whatever color it is, and that was the case. So here, this was our high point candle. So it is a bearish engulfing. It's not great to see. Like I said, I'm not happy about the action in gold recently, so it's not a hard buy anymore. Plus, you have the PPO poised to make a bearish cross here, but it is at support. And if I'm right on where the market's going, you'll probably see a flight to safety bid in that. And I still think the euro looks good. So ditto for silver. Silver should follow gold if it breaks out. And then on the mining stocks, keep in mind same thing from a longer term perspective. You've got the big bullish falling wedge on the weekly chart here. You had a breakout. Nothing goes up forever. There was our breakout candle right there on the weekly, right here. I'm trying to circle it. Trying to click my circle tool. And that's it. And then we went up. And we hit that was my first target. You go look at the charts back then on the weekly, 40.29. We hit that target. We had a reversal. I'm not crazy about how impulsive the reaction is. That is a bearish engulfing candle. I don't like that. So, again, it's cooled me off a little bit, but it hasn't changed the whole bigger picture yet because we're still well above the breakout, and we got pretty stretched, a big run in the minors, and we're back to support about 34.90. Again, these are levels I've had on this chart for a while. That was created back in December 17th, and this one back here back on July 25th of 2019. So big levels. Pullback in a bull market is what I'm viewing this as. On the daily chart, and I'm sorry I missed this. I have my gold mining stocks and silver miners in my I'm not actively trading those. They're not in my active trading account. They're in IRAs and longer term accounts. I mean, hardly looked at them because I've been tracking gold, and gold's been looking fine. But we did have this wedge here with a divergent high. And again, in hindsight, had I seen that big divergence forming right there and the trend line break, I would have pointed it out, but I didn't. And again, all I can tell you now is, hey, I missed that breakdown, but we are at support on the weekly, as I showed you, and the longer term chart's still constructive. So this will probably prove to be a buying op, whether there's a little more downside here or not. But anything much above that, you may want to start letting it go or give it room. If you look at big picture, it's been a multi-year consolidation. Bulls win if they can hold above this level and then break out, especially break out above those highs. Bears win if this level here goes about $29 right there. That's bigger picture stuff. And again, you can see it on the weekly like this. Alrighty, let's wrap it up here. That covers the equity markets. Again, very near term, other than the bounce, which we've pretty much now already had. I don't know how much upside's left in that. That was very near term, micro call right there. Other than that, remain still intermediate to longer term bearish on the equity markets. Intermediate to longer term, or intermediate term, I should say, near to intermediate term bullish on Treasury bonds. And then gold at this point in time bullish, looking to buy, still longer term bullish. And in a bull trend, I look to buy pullbacks to support like we had today in gold. It's that simple. All right, guys, I'm going to wrap it up there. This has been Randy Finney with Right Side of the Chart. Have a great day.